Thank you everyone for attending this panel. We're going to try to make it as interesting as we can, and please don't hesitate either via the app or directly to ask us any question. I'm very honored to share this stage with my partners here. Adam Button, who is Chief Currency Analyst at ForexLive. Ahmed Behdenna, who is our Senior Strategist Multi-Asset at Aviva Investors. And last but not least, my colleague at Societe Generale, Alain Bokobza, who is head of our Global Asset Allocation Research. And I should mention that this research team has been granted 10 times in a row #1 Excel cross-asset research. So the purpose of this panel is to discuss what multi-asset means in 2018 and to discuss it starting with FX but going beyond FX. First of all, one of the starting discussion we had when we were discussing together was the fact that in many buy-side firms and in many asset managers, rarely you have a portfolio manager who is fully and only dedicated to FX. We've got multi-asset, PM, who are looking at FX as a key asset class, but rarely we've got portfolio manager dedicated to purely FX. So the first question I will ask the audience, and maybe starting with Ahmed, who is our senior strategist, is, well, is FX considered as pure asset class on the buy side? And maybe talking a little bit about the day-to-day and maybe some history regarding the FX asset class going on with Alain. Ahmed, thank you.
Thank you, Marc, for thank you for the introduction. So I think from my, let's say, perspective of running multi-asset funds, I think FX is a key part of our process, especially, let's say, in the last few years where you had significant movements in those markets, or even if you look nowadays where volatility in other asset classes is basically on the floor. FX volatility is maybe the exception to that. You can make that argument. So I think there is value in understanding dynamics in forex market, and is also a way to diversify portfolios at a time when cross-asset correlations might be challenging. So my answer to you is that it became more and more important, and I imagine that in the next few years it will remain very important to investment processes.
Thank you, Ahmed. Alain, FX as an asset class, obvious or not? A bit of history on that front.
One has to remind that FX is a brand new asset class. It is an asset class, but its history is very young. If you do remember, we started free floating exchange rate system with the gold standard ending in August 1971 and Bretton Woods in 1973. That is very young. When you deal with the credit market in the US, you start at the beginning of the 20th century. Equities, the S&P 500 started in 1871. You have commodity prices dating back to the 14th century. I can give you the gold price since 1453. So FX is a new asset class, and as such, we have little knowledge about it. And that maybe frightens the asset management industry, as you do not have tens and tens of cycles over the longer period of time to modelize. And the second feature is we had gradually after 1973, let's call it the G10 currencies in the developed world. In the emerging world, back in the late 70s, you had none of the emerging currencies trading freely. Since then, I think you have maybe one or two remaining currencies in the emerging world which are not freely floating. All of them are freely floating. And in August 2015, China started to open up their currency regime to free floating, the first steps. So I think we are heading towards a status, not only within G10 of an asset class, but the new feature is that when you invest the EM's investment space, you also have the freedom to trade long or short all the other currencies, and that is a beautiful word.
Thank you, Alain. Thanks a lot. We are discussing cross-asset. We are discussing capital market and policies, central bank policies. 2017 and their impact on FX, on other asset class. Adam, do you want to say a word regarding 2017 and going forward, what you are foreseeing?
It's interesting what Alain says. In the history, it's also given central banks little data to draw on. And in a sense, what we've seen late in 2017 is central banks misunderstanding the impact of currencies and rate hikes. So we had the Bank of Canada hike rates 2 times very quickly, and it forced the Canadian dollar much higher than they anticipated, and it fed back into the model in order to create a greater hike than anticipated, and they had to walk it back. And looking to 2018 and to this rate hiking cycle ahead, I think we're bound towards a period of central banks acting and then having to step back once the market overreacts. And I liken the market right now to like an English football fan who has a new hot prospect coming up, and he's on the cover of every newspaper, every magazine. And the moment you have this young central banker score a goal, for instance, everybody's betting on his career and wanting to pay him, and the market and the money floods in. And then, as reality sets in, there's this disappointment over and over again.
Fair enough. Any comment expanding on this, Alain?
One feature which strikes me at the moment is that it seems we are in a market where prices are freely floating. And because of central bank interventions for a few of them, namely the Fed, the Bank of England, the ECB, the Bank of Japan, who intervened a lot by buying bonds of their own country, some prices are administered by these central banks with what they nickname the forward guidance. And when you listen to the latest statement by Mario Draghi, the Italian man managing the ECB, he's very clear that he's managing the volatility on the currency. That is one of his targets. Very brand new. The Bundesbank never did that for the Deutsche Mark. So in that sense, the low volatility regime we have in link with the forward guidances we have on the central bank, we are all listening to them. We all have the same inputs and the same conclusions. What I'm being told by my asset managers clients, saying, Alain, you are very much in the consensus, you are boring. I say, hey, I just have a forward guidance, that's it. I'm not going to go against my central banker. So back to where you find areas where you can build your own brain and ideas is outside the administered prices. Back to the EM word.
Ahmed, is Alain boring?
Well, nowadays I must say, no, I'm joking. He's okay. So I think he highlights a good point, though. I'll go even one step forward. I think that illustrates your previous point on how FX can be useful. So if I continue on the example Alain highlighted on the European Central Bank, and you look at what happened this year, so you had obviously the economy in the Eurozone doing better, and the way the market decided to price that was actually through the currency. So you saw little moves in bond yields, but you saw a 10-15% appreciation in the euro dollar this year. So that I think illustrates the way illustrates how FX can be useful to express views in the market nowadays.
Please,
I'm interested. You could almost argue that FX is the most direct channel now rather than bonds, except for some very short-dated interest products. I mean, FX is, and it has more of a lasting effect. I think for somebody investing, in some short-dated interest rate futures, you would get that move right away, whereas FX, move like the euro, there's a little bit of a time factor that would benefit an investor getting in or out. So it is turned into a real proxy for central banks and news.
Thank you. Well, we've covered a lot about the fixed income space, or we touched upon the fixed income space. Equity, we obviously look at for our clients internally, but on the multi-asset side, obviously a lot at the foreign exchange and the equity market links, correlations. I'm thinking Korean won and KOSPI, Nikkei dollar yen. Dollar yen has been quite a currency of focus recently. Euro dollar S&P. What's your view in the coming year, 2018, on this? Your view in between equity and FX and the correlation, non-correlation we could see in between those markets. Starting with you, Ahmed, if I may.
This is becoming a trend to start with me. Thank you, Marc. So, the way we look at this, kind of, strategy work is the following. We think we have a theme which is about fundamentals mattering more for markets, and I think we see that clearly in equities. So you see a lot more dispersion within the equity market, which basically means that in the past few years, if you look at each stocks within the S&P 500, they would tend to move together, whereas in the last few quarters, you're starting to see a lot more of this stock is doing this and another one is doing something else. So a lot more dispersion. And I think that might explain why correlations between equity markets and FX are more or less normalizing. I think what was not really normal is the fact to have consistently very high correlations between FX and the underlying equity market. It is the case in Japan. The correlation between dollar yen and Nikkei has basically weakened significantly. I think it's a development that should be welcomed, and it is part of the normalization of global markets.
Alain, any comment on the matter?
I think we could bring two angles. One, leveraging Ahmed's ideas. Most people in our field, in our area, work on observing past correlations and making forecasts or not making any forecast, continuing the same correlation level. Where the only added value one can bring is to think about, can the correlation be stable or not, whatever the level. So it's the break in the correlation regime which is of interest. You have a break currently underway in a rather smooth way in Japan. You have another break at stake at the moment between sterling and the FTSE, where normally FTSE goes up when sterling falls, but since we all understood that there is no plan in the UK for now, there is a way to do Brexit, but nobody knows exactly which Brexit, how much, how long, whatever. So there has been a decorrelation. So FTSE has stopped outperforming when sterling was falling because there is a political risk premium happening now. And a second angle, so it's a forecast of the correlation regime which can be of importance and a lot of work, and then you can differentiate yourselves. And the second angle is that through what we call the smart beta index platform, so the basket of stocks, that within the equity markets, if you take the FTSE, for example, there are some stocks which have a higher correlation to sterling than many others. And if you identify those one in a basket, then you can trade efficiently your currency forecast and impact on the equity markets. And the market know that you have the Delta One activities, the smart beta platforms from all the investment banks going on. That is a much, much better added value and much purest within that. So there are two ways you can leverage and make the ping pong game between the currency markets and the equity markets.
Thank you. Adam?
I'm interested to see in the year ahead how the correlations hold up. For me, there are two nexuses involved in that you have rising growth, classic central bank inflation-driven currency rally, which can also be good for the equity market, versus political volatility, which may have depressed a currency like sterling over a time, and then the relief from that, which doesn't necessarily feed through into the central bank in a low inflation environment, and how that currency strength translates into equity market strength, and it might not be there in the same ways it has historically. So I think a lot of the classic correlations are there, but I think there's an argument for some caution as well on some of those fronts.
Any additional view when it comes to this major geopolitical event than the EU referendum is, and its impact on the sterling and on other asset class from your point of view?
So I think you had a structural change in the outlook for sterling, not cyclical, but structural with the uncertainty. Again, it's very interesting to see the way FX prices that. So it's a matter of days before the information is basically in the price. And then we evolve according to, kind of news flow. Obviously, there's a lot of uncertainty. Nobody can predict the future. But if you look, for example, at usual valuation frameworks that are used for sterling, I think you can put all of that in the bin, basically, because you have a structural change to the outlook going forward, for example, in terms of trades. I think it's here to remain with us until the negotiation reaches a conclusion.
Alain, do you share this view? And expanding as well on the equity front, we had a few clients asking us our views as well, obviously on the stock side when it comes to the Brexit.
Back to the usefulness of an asset class to make a ping-pong game with the market availability of ideas. So here we're talking politics. And in a free floating exchange rate system like we have in the UK, it is the best and the easiest entry point. It's super liquid, super easy, and the information flow can go directional. So that's beautiful. It creates volatility as such. And it is the same globally. When you deal with the political problem, if you have a free floating exchange rate system, which was not the case for Greece years ago. So when you do not have a free floating exchange rate system for some of the countries within the euro area, then the bond market becomes the point of attack. And it was the attack when bond yields went through the roof in Greece when you had the start of the attack ahead of the bankruptcy. But back to the link here. The currency is always the point of attack when you have a geopolitical problem in one country. I would say for most of the country it is this. Then some other assets like oil, obviously when you have a problem in the Middle East, so you have a competition. Oil can be the hostage when you have some turbulences in the Middle East. So these are the two ones, I would say, among the assets. Equities are just the consequence of the FX variations. In that sense, equity markets are a sub-function of the equity market. The FTSE, since Brexit on June the 23rd last year, has most of the time been a sub-function of the currency evolution, a sub-function. So currency forecasting becomes even more essential than at any point of time in the history.
Thank you. Thanks a lot. Please.
When Macron was elected, remember 18 months ago where the probability of Macron to be elected was from 0 to 5%. Many of you didn't even know his name. And then the more he came and beat it, finally 65 to 35 against Le Pen, then the euro went through the roof. Went through the roof because you changed the risk premia on the euro area assets, not only the CAC 40.
Fair enough.
So back to the currency, part of the rise of the euro in 2017 was due to the calming down of the worst of the fears against populism. Back to politics.
We touched upon fixed income, equity market in this multi-asset, what multi-asset means, including FX, around FX. Commodities. We've got now a famous publication that we are distributing to some of our clients called When Commodity Meet FX. What are your views? Maybe starting with you, Adam, when it comes to those very linked market, when it comes in particular to the commodity, so-called commodity currencies, and your forecast for 2018.
It's interesting because you have sometimes the currency is an indication, pardon me, the commodity is an indication for the currency. So you would look at Australia, you'd look at iron ore, Canada oil, on and on. And at other times, it flows the other way as well, in that you have this struggle in the economy filtering back through into the commodity. And if we look at maybe the Canadian dollar, you have oil prices, and for commodities to filter back into FX, it needs to get to a certain point to spur new investment. Right? If you have something like an oil project over, let's just simplify and say over 20 years, you'll make $1 billion a year, but up front you have to invest $15 billion. So that huge investment at the start is going to be very currency lumpy, and whereas a higher price coming back on the other side might mean $1 billion, 0.1 coming back in a year, which is a small, easily absorbed currency effect. So commodities back into the FX market until we see something akin to 20, 30% gains above where we are now, so real signs of shortages and investment. And I think you have, it's similar to consumers in the post-crisis era, that commodity producers are reluctant to invest heavily in any project until they see prices far above the rate of return. So I don't see commodities as a driving factor. I see them as an indication of the health of the global economy. And into 2018, that global synchronized growth story is the dominant story and the dominant theme, and how central banks take that and decide to run with it, and how I think the bold will be punished by the market or rewarded very quickly with rate hikes, only to have to take them back. And I think that's the trade over and over again. And then I think it will be a lot like 2017. The best trades this year have been political. In the euro, it was Macron. In the New Zealand dollar, just recently, it was selling the currency on a political surprise. And it's as simple as just monitoring for political surprise. And right now, even tomorrow, we might have a vote in the United States, and it's the United States is full of surprises on tax reform and the ebb and flow of Brexit as well. And these are, I think, the trades that have been the best opportunities in 2017 and probably will be again in 2018. But at the same time, I think politicians are getting wiser to the game and happy to let their currencies languish. I don't think it bothers Theresa May to have sterling at 130 as much as it's maybe a blow to the national psyche.
Alain, your view on those two spaces overlapping and being correlated?
The work we have been doing on the link between commodity prices and currencies signals for some commodities and some currencies there is an extraordinarily strong link. Namely, out of the 24 commodities within the GSCI index, 9 of them are extraordinarily influential on 9 commodity currencies, as we nickname them. On top of which, you have gold, which can be analyzed as much as a commodity, as much as a currency. So you have 10. So 10 currencies are extraordinarily sensitive. To make a few examples, 56% of Chile exports are copper. One can imagine how and why the Chilean peso is extraordinarily linked to the copper price. And most people work on correlation and co-integration. We try and build forecasts on the copper price and have a view on the Chilean peso itself. And then you improve the capability to make a better forecast. It's
Ladies and
currency forecasting
gentlemen,
remains extraordinarily
please
difficult.
join Suzanne
to improve.
Kishti at
Because
10:45
you
in
have
the
a
seminar
fundamental
room
analysis
as she
which
maps
is
the
behind.
landscape of RegTech
Like
startups.
the Russian ruble
Where
is
is RegTech
extraordinarily
headed?
sensitive
With a
to the oil
360-degree
price by the
view and
definition
in-depth
of
case
the
studies in
added
our
value of the
seminar
Russian
room on the
economy,
mezzanine
which is
level in 15
exporting
minutes.
oil and gas. So yes, the link. And from time to time, as it is now, by the way, you had an extraordinary push of the commodity prices thanks to the global resynchronization that I was talking about of the global economy. And some commodity currencies have lagged because US rates are going up and all assets linked to commodities and EM have lagged a bit. And there is a dislocation, which is beautiful at the moment. Commodity currencies have lagged the commodity prices. One of the two is going to move, either commodity currencies up or the commodity prices down. But there is a convergence process which will happen.
Ahmed, this time you were not the first. Can you give your view on that front?
I do agree with Alain. I think it's quite interesting the kind of divergence we've been seeing recently. So commodity prices being supported by, let's face it, the kind of best outlook for global growth since a number of years. And on the other side, not a lot of movements on commodity currencies. I mean, if you take the example of oil, you have had a good repricing of oil prices, spot prices. But if you look at the curve is now in backwardation. Basically, spot prices are higher than prices in the future. But the whole curve is moving higher, which means I think the market might be telling us that higher oil prices in the future might be sustainable, and this would have an impact on linked currencies. So I agree that it's might be an opportunity for the future.
Thank you, gentlemen. Well, we are coming slowly to the end of our discussion. I wanted to pick your brain for the audience in particular on your main view for 2018, in directional, in terms of volatility as well. What multi-asset will mean in 2018, asset class-wise, volatility-wise. Not necessarily investment recommendation, but your conviction and market view. If each of you could give its key conviction, I think that would be very useful for the audience, and we'll take then some questions. Shall I start with you, Alain?
"12 months ago, when we were dealing with the 2017 outlook, our world was full of fears. Donald was just elected in the US, protectionism, taxes, populism, racism. We're on the eve of the French election. Le Pen was on the agenda. Brexit was on the agenda, bad management. China was on the eve of hard landing. Climbing a wall of worries has made 2017 a beautiful bull market. Those who have lost money this year had no luck. Overall, we are going to start 2018 with the inverted proposition. When I do listen to my chief economist, it is the most beautiful world they have been living from an economic standpoint in the last 10 years. Ooh, okay, we are starting with extraordinarily bullish economic scenarios, and the volatility regime is all-time high. So I fear that if 2017 was climbing wall of worry, which makes the bull market and the capability to deliver some expected return with a low volatility regime, 2018 is going to be significantly more challenging. And so we need to back on one of the ideas that the US dollar has to continue to be an extraordinarily weak currency, back to the FX markets. We have been saying that throughout the year. There is a temporary hiccup with the rate hike from the Fed by December, but structurally, the US economy is tired and the US dollar is tired and too expensive. And among the bigger risks we highlight is the fact that there is systemic risk generated by the short vol strategies at when the vol is so low and the quantity of short volatility strategies is so high, there is induced risk. I think nobody manages at the moment properly, but that is one of the bigger risks I highlight for 2018.
Thank you, Alain. Ahmed?
So for kind of next year, we think on the kind of economic outlook, it's a continuation of this year. So upside risk on global growth. What's probably more interesting for global markets is that we also see risk on the kind of inflation side and the answer from central banks. So while our, let's say, central scenario is for gradual, tightening of monetary policy in the US in particular, and even more gradual in the Eurozone, basically inexistent in Japan, the risk for global markets is that you kind of see inflation pressures appearing and the Federal Reserve has to tighten policy quicker than expected. Now that would raise a risk, because as Alain mentioned, you have at the moment a very low volatility regime across asset classes, and this is a scenario that is not at all priced in within fixed income markets, for example. So I think the risk of repricing of the volatility regime is actually more acute in fixed income markets than in equity markets for the coming quarters.
Thank you, Ahmed. Adam?
Yeah, I believe 2018 is an amazing year. I think we're headed, in terms of the global economy, in terms of the global challenges, humanity is at a better place than it's ever been before. And markets are more open than they've ever been before. And what I think we'll see is something akin to Bitcoin, where anything that looks like a good idea, or Amazon, or even some of the currencies that have rallied this year, will overshoot. I think we're at a time of overshoot, and it's a very difficult time to invest because it's so hard to chase something that's done so well previously. But with bond yields so depressed, you have to chase returns in hot assets. And I think over and over again, we're going to see assets moving to sky-high valuations because there are really no economic risks. Politics has been a disaster over the last 2 years, and it hasn't derailed really anything. And I think that is receding. I think it's getting better. I think the market can look at some of those political risks and say, well, maybe they're not as bad. At the same time, with volatility so low, nobody wants to be the last person out the door. So that news risk is super high. And I think that is really the trade, is just to grab on to whatever's hot at the moment and jump off the moment some really hard-hitting negative news happens. And it will happen in asset class after asset class, but it's just about chasing the hot thing. And as it's a sort of lame as an investor, but I think that is the game for 2018. And even when the bumps in the road come, I don't think they will be that severe. So the volatility will kick up and overshoot again, and then it will be time to get back in. And this sort of progressively higher and higher markets will continue for 2018 and probably 2019.
Thank you, gentlemen. We had AAA advice. Thank you, Alain, Ahmed, Adam. Thank you so much for this interaction. You are more than welcome to ask any question either via the app or directly. I know that there is potentially a mic in the audience. We are happy as well to take a question, aside after the conference. Welcome to ask anything. Jonathan, I think you are in charge of this app intermediating. Yeah, there is a question from the app, so let's see.
One of you has asked, what does Trump courting Saudi oil to list in NYU tells us about proactive government in the coming years? So if anyone wants to take up on that, that would be good. Again, what does Trump courting Saudi oil to list in New York, basically, tells us about proactive governments in the coming years? Will we see them interjecting more, or
I mean, I would be scared to extrapolate anything that Trump does to other governments. I mean, at the moment he is unique, and sure, populism has risen, but the Donald Trump brand of populism is as unique as Donald Trump himself. However, I think that alone, it is a trade. I mean, I think it's a sure shot trade that the Saudi IPO will be listed on the New York Stock Exchange. Donald Trump sees himself as a deal maker. I don't think he would have said something like that and put himself at risk of a listing somewhere else, unless somehow he gets played by Saudi. But I mean, the U.S. holds the trump cards in that. So listening to Donald Trump, and I think everybody has a bit of a better understanding of him and how he acts. And I think the market will be much more efficient in pricing what he says in the year ahead, if that's possible.
Okay. No more questions from the app, I understand?
no?
So thanks a lot. Thank you, guys. Really, really pleased opening this Finance Magnet London Summit 17 with this panel. And we'll stay around for the next 5-10 minutes to shake hands and discuss. Thanks again for listening, and thanks to you guys for your insight. Thank you.
Thank you.